Hello. Welcome everybody in person and online to the Peterson Institute for International Economics. My name is Chad Bown and I'm the Reginald Jones Senior Fellow here at the Peterson Institute. We have had 3 wonderful days here at PIIE for the 42nd PAFTAD conference. It's been an honor to be a part of this. Thanks to our friends from all across the Pacific for allowing the Peterson Institute to host this incredible event. For the next 90 minutes, I will be the moderator of a panel titled Industrial Policy for Asia and the Pacific, Lessons in Future Directions. We have 4 tremendous expert panelists who I will introduce and you will hear from momentarily. But before we get into that, I thought I might reflect on some of what I've learned both over the last 3 days and over actually the last 5 years when it comes to this resurgence of industrial policy that we are now all seeing. This conference made me put some of my own experience into perspective, and it was also quite nice because here in Washington, we haven't really said anything other than the word tariffs for the last 5 months. So it was nice to have a little flashback and to be able to think about something else, industrial policy again. So for me, I think like a lot of us, I started thinking hard about industrial policy probably around 2020. I, before then, had not spent my academic career researching industrial policy too much. But in 2020, that's the moment that I would argue the United States first began its hard pivot into using industrial policy. And at that moment, it was largely in reaction to the pandemic. First were the product shortages of personal protective equipment, where the United States ultimately ended up spending over $1 billion to not only expand production, but sometimes to build entire domestic supply chains of things like rubber gloves and hospital gowns and masks and things like that, where there had been severe product shortages. And then second, during the pandemic, we suddenly had the need to scale up manufacturing of COVID-19 vaccines. These products that were innovated and then had to be built, or facilities built from scratch, supply chains built from scratch. I watched those events like everyone else, but as a nerd, I got excited. Partly it was dealing with the trauma of the pandemic, of course, like we were all doing, but I thought, hey, here's a chance to study supply chains and what's going on with industrial policy. So I talked to industry experts, I talked to government officials here in my country, and I learned a couple of things, especially with talking to government officials. One is that they were really freaked out. And the thing that they were increasingly worried about was maybe 2 things. One was recognition about the increased concentration of sourcing for certain essential products, right? The first one that kind of came to mind was PPE, which was heavily concentrated in production in China and other places in Asia. But then obviously other products emerged after that. But the second thing that policymakers, I think, became aware of is, at least here in the United States, was how in an emergency, if you have some local production, it's a lot easier to scale it up than if you don't have any local production at all. And relying on international trade, as wonderful as it is, especially for us international trade experts and economists, as a source of diversification and access and comparative advantage and all the wonderful things, in an emergency, it makes you feel sometimes a little bit vulnerable. Right? And the best evidence I can give of that is here in the United States, we have this thing called the Defense Production Act. In an emergency, the government can step in and ask local firms to do really extraordinary things with their supply chains, with their production. Things that are just impossible to get those firms to do if they're only producing internationally in a foreign country. Just the legal instruments, the policy instruments aren't available to policymakers. And so when the fear and the panic of the pandemic hit, right, I think this really hit home to policymakers. So we had that. And as a nerd, I wrote papers about those things. I found them fascinating. And then we saw other product shortages pop up, the semiconductor product shortage in 2021. That wasn't because of anything malign, really. It was largely due to a mismatch between supply and demand that happened in the time, given the peculiarities of the pandemic itself. But just the existence of the product shortage, I think, caused policymakers to look harder at those supply chains. And when they did, they saw things like, wow, more than 90% of high-end chips are produced in one place, Taiwan, which is a kind of a hotspot in the world. And we're not sure that having that much geographic concentration of production in one place is really good for the global economy. And then they looked at things like critical minerals, right? And we already saw some research being presented at the conference over the last couple of days onto this point, and how that was increasingly being concentrated as well. And so you had, for semiconductors, you had the introduction of the CHIPS Act in the United States. And then for things like critical minerals, you had the Inflation Reduction Act and the really creative provisions in the Inflation Reduction Act trying to establish alternative sources of supply for things like critical minerals through the consumer tax credit provisions, this thing called Section 30D, which then filtered down to the batteries and then the critical minerals that go into the batteries and trying to get those sourced in new places. So I wrote about those case studies too. And then somebody asked me to write a survey about industrial policy and to try to put all of these kind of case studies together. And I did. But as I was trying to do that, I realized there was really not much at that stage in our discipline that fit as a framing mechanism what I thought policymakers here in Washington and in other countries around the world, Japan, Korea, I think a lot of Europe as well, were thinking about when they were making this pivot to industrial policy. So what I did was the best that we had, which was this amazing handbook chapter that Ann Harrison had written with Andres Rodriguez-Clar, which I drew from heavily when I wrote my survey. But its framing, and this is a beautiful and important framing, its framing was very much about, this is how we think about industrial policy that developing countries are using to help further their economic growth, right? And that's not really what's happening here in a country like the United States that I had been experiencing or trying to understand over the last couple of years. In rich countries, it's really about something different, right? It seems to be about being worried today about being cut off from supplies of some essential product, oftentimes because of the market dominance position of a potential adversary, right? And so we've heard a lot of talk over the last couple of days about geoeconomics, geopolitics. What I would ask our scholars is to push yourselves a little bit farther, and what do you mean by that? What are government policymakers really worried about when we talk about geoeconomics and geopolitics? What I think they're worried about, and many times we're worried about, is market dominance, right? And having products cut off because there's just very, very few suppliers of things out in the world. Okay, so that was my academic experience, and then I went into government. As a political appointee of the last administration, my liberation day was January 17th. But before that, I was the chief economist of the State Department, and in that job, I got to actively work on the process of trying to implement cooperative industrial policy with partners and allies, countries that have the same underlying economic security concerns that you do. And what I can report is there is a lot of stuff, or at least there was a lot of stuff happening there, attempts to cooperate over industrial policy, right? Things happening behind the scenes, right? So let me give you maybe two quick examples and then I'll wrap up. Did you know semiconductor supply chain, for example? We saw a wonderful paper at the conference on things happening in Thailand. Well, everybody knows that in the CHIPS Act, right, and also what Japan has done, countries in Europe have done, there's been a lot of focus on subsidies for semiconductor fabs, right? These are the plants that cost $15 billion, $20 billion to construct, right, to build the high-end chips. Well, the way the semiconductor supply chain works is that's not the last stage of production. After I think of it as like a pizza, comes out of the oven at those $15 billion plants. It then has to go off to another production facility to do what's called assembly, test, and package it up for kind of use in consumer electronics or automotive sector or whatever. That ATP facility is basically always in an emerging market, right? It was kind of one of the first parts of the supply chain that was outsourced and offshored in the 1960s, and nowadays it's in developing countries all over the world. Well, the point of that is, if you're the United States and you want your CHIPS Act funding on fabs to work, you also have to make sure the last stage of the production process is going to work as well. So with the State Department, it turns out that under the CHIPS Act legislation, the State Department was given $500 million over 5 years, part of which was used to work with partners in some of these emerging markets to help them establish the right ecosystems for those sorts of facilities to show up. And so that meant working with the OECD to do studies, and then ultimately to fund workforce development programs, at least to start, in a lot of those countries. There's countries like Costa Rica, Mexico, Panama, Vietnam, Philippines, and things like that. But there's one example, looking into the details of industrial policy today, of it happening on a cooperative basis. And then the second is this thing called the Mineral Security Partnership, right? So one of the big challenges out there in the world today is the market concentration, especially in the processing of a lot of these critical minerals, right? And so what you've had come up over the last couple of years is a coalition of buyer countries. So this is the United States, Japan, Korea, Europe, all countries that want access to secure supplies of critical minerals for things like the batteries that are going to go into their electric vehicle industries, a coalition of them, and then a coalition of mining countries, right, that are looking for, not just one buyer to process their rocks coming out of the ground, but they want alternative choices as well, right? And so you've had these coalitions come together to try to figure out how to establish new sources of supply, especially of the processing, in third countries, right? And this has been a challenge to do, right? You've got to get these countries together, you've got to get the institutions together, and then you've got to come up with the money to be able to fund projects in these third countries. So that was part of what was taking place under the Mineral Security Partnership. We'll see how it continues to go these days, but it's being, I think Korea now is leading that initiative in the current year. In any case, to conclude, thanks again for the opportunity to be here. There has been an incredible amount of things that I think we have learned. My last piece of advice for all the economists and scholars that are working on this is this really is, at least in a country like the United States, a very different era for thinking about industrial policy. A lot of the frameworks that we had developed in the past aren't quite right for helping us understand what's going on today. But if we really want to make a contribution, and I think economists have a huge role to play in helping policymakers understand this and making a contribution, we also need to work really hard to understand what their underlying objectives are. So in a sense, my advice would be, after we're done talking to each other at a conference like this, we now go off and we talk to the policymakers and we listen to them and we ask them, what are you actually really, really worried about? Tell me about that. Tell me about the market failure, or I'll help you identify what the market failure probably is. And then we can work together to figure out the ranking of policy instruments that are going to help you achieve that objective, right? And still use economics to help us get there, right? So don't shut us economists out of the policymaking process, even though we're heading into this new world of industrial policy. But again, this is not the industrial policy of seeking to, maximize economic growth, TFP, agglomeration economies. This is really, really about something else. Okay, with that, let's go to our panel. So let me first introduce them, and then we're going to have them come up one at a time, and then we're all going to go, or they're all going to go up to the table to have Q&A from the audience. So to start, let me introduce the four panelists. The first is Mari Pangestu. She is a professor of international economics at the University of Indonesia, a distinguished visiting fellow here at the Peterson Institute. She has formerly been at the World Bank and also Indonesia's Minister of Trade. After Mari is done speaking, we will have Professor Ann Harrison. Ann is a professor at the University of California, Berkeley, where she most recently served as the 15th Dean of the Haas School of Business. And in addition to, everybody should read this handbook chapter I was mentioning about, that Ann wrote about industrial policy. Ann is one of the world's great economic scholars of industrial policy. For all those of us that are new to this topic, read Ann's stuff. She has been doing this for a long time. And also at one point, she was my boss at the World Bank. We also have Danny Kwa. Danny is Dean and Lee Ka-shing Professor of Economics at the Lee Kuan Yew School of Public Policy at the National University of Singapore, and he has also been on the faculty at MIT and LSE. And then finally, we will conclude with somebody who needs no introduction, but we'll give him one anyway, Ross Garnaut, who is Professor Emeritus at the University of Melbourne in Business and Economics. Okay, so we will go through them, but we will start with Mari.
Thank you, Chad, for that kind introduction. Let me jump straight into my intervention, and I'd like to make 3 points. But first of all, I'd like to join Chad in saying that we've had a really rich discussion around industrial policy. Well, some call it new industrial policy in the last 2 days. So some of these views that I'm sharing with you come from the last 2 days of really excellent discussion. So I want to make 3 points. First, industrial policy is back and it's here to stay. Second, what do we see as the critique and evidence of current industrial policy? And most importantly, as PAFTAD conferences go, we want to talk about the road ahead towards what we could call a sensible industrial policy. So first of all, industrial policy is back and here to stay. Even though there is a terminology of new industrial policy, I think we all know that industrial policy is not really new, but it is back with a vengeance, and it is being deployed more extensively and purposefully with many more objectives. The objectives and motivations, I guess, are new. It's no longer just about economics related to correcting market failure, job creation, targeting certain sectors, but the so-called new motivations are more related to national security, climate change, resilience of supply chain, and strategic competitiveness. And we had several papers and many papers on industrial policy now refer to some of the databases now that we have on industrial policy being measured by the Global Trade Alert and others. And the main trends that you see is really that there has been a very significant increase in the use of industrial policy, no matter how you define it, no matter how you measure it. Just as a number, there have been 147 industrial plans after 16th of August 2022, or since the US IRA. And there has been an increase in the different types of motivations or stated motives. As I mentioned, it's climate change, national security, and geopolitical concerns, security of supply chain, and strategic competitiveness. And the increase of the countries using it is not just the advanced countries like EU and US, but also the large developing countries such as China, Brazil, and India. And the types of instruments used, I think one of the papers actually analyzed this very well, that if you look at the types of instruments used for climate change and strategic supply climate change, strategic supply chain, as well as the use of the instruments there, and for competitive liberalization. A lot of the competitive, I'm losing that terminology. Competitive, what is it called? Strategic competitiveness. They use a lot of subsidies and some trade instruments, where the trade instruments are export and import restrictions, as well as some export incentives. But a clear use of subsidies and some trade instruments. But it's where you get to the international security motivation, you see that the instruments used are a range of, what would you call it, less than usual instruments. Like, yes, they use export and import restrictions, but they use other controls on commodity transactions and investment, foreign direct investment restrictions, and the other types of the usual industrial policy instruments are less used. So this is really, I think what you're seeing is many more many more motivations, many more use of IP instruments, industrial policy instruments, and they are being used with limited regard to disciplines and WTO rules, especially the ones on being used for security exceptions, and definitely erosion of subsidy disciplines and challenges in enforcing transparency and accountability around government procurement and IP-related, industrial policy-related measures. So the reality is industrial policy is back and here to stay. I think one of the papers also highlights that industrial policy has become more costly because of the structural obstacles and the headwinds, such as higher capital costs, political uncertainty, and stagnant foreign direct investment, and so on. So I think this is the trend. The second point I wanted to make was, what does the critique and evidence on industrial policy tell us from other papers as well as the papers in this conference? I think what we see is that there is a lack of clarity of objectives. What exactly, I think Chad also put this point forward, what exactly are we trying to get to with these industrial policies? They tend to have multiple objectives, and there's no strategy often to achieve these objectives. And if there's more than one objective based on Tinbergen rule, there actually should be more than one instrument. And oftentimes that doesn't happen. And also we also need know from good policy practices, these instruments need to be well targeted. So really a lot of the analysis show that many of the current industrial policy programs lack internal coherence. They fail to embed monitoring and evaluation from the outset. And we know that governments, why they're here to say is that governments are facing political pressures to deliver, and they come up with quick wins, sometimes influenced by vested interests that lead to very poor targeting and weak enforcement. And there were some papers also that talk, what is the evidence on good industrial policy? And a lot has to do with how you measure success, such as exports. Export orientation in the past has led to good industrial policy because it's easy to measure, it's transparent. And when you have competition and strict accountability as part of your industrial policy. And by the role of institutions, I think, came out also as a very important issue in terms of being able to, having the implementation and the capacity to be able to deliver on these industrial policy. So let me now close on the constraints and experience of industrial policy today, including all the recent trends, is really, really clear. But what we need to talk about is really the road ahead for a sensible industrial policy framework and disciplines. If not, then I think we are going to be really in a world which is going to be very fraught and very fragmented. So first of all, at the national level, I think pathways and a roadmap for sensible industrial policy, and there were a lot of kind of frameworks and principles that came out in this conference, such as embed a diagnostic-based approach, identify the bottlenecks that you're trying to address, and the competitive niches that you really want to develop. Design a pro-competitive industrial policy, avoid policies that protect incumbents at the cost of dynamic efficiency. And I think there was also a lot of discussion about the kind of instruments you use should be price-related, not quantitative restrictions. They should be transparent, and they definitely should be linked to competitiveness. And I think there's a lot of data now available. You use data and firm-level analytics to understand what works and what doesn't. And I think there's, the principles that we used to adhere to as to good industrial policies, such as performance requirements, sunset clauses, disciplines in its use, and the key role of institutions, I think still are relevant. But in today's context, it may be less relevant in the sense that there's so much on the using of security, and the fact that we don't know how to manage the spillovers and the distortions. and the unintended consequences, such as overconcentration, risk of oversupply, and increasing prices. So I think this is, unless you're a big country, you are going to have a lot of risks, such risks. So the other discipline or the road pathway forward is related to what do we do for international cooperation? Is there a pathway for international cooperation to discipline what countries do? There were a few papers and a lot of discussion around this, because in the past, at least in the case of Indonesian experience, international discipline has played a role in disciplining the kind of industrial policy we could do, such as the fact that in the WTO, we were no longer allowed to use local content requirements. And so we stopped using them. But unfortunately, they're back, and we're using them again. So how do we have international cooperation and disciplines, which actually can help governments that are under pressure, under domestic pressure, to have the political cover of having to adhere to certain disciplines and international arrangements? I'm running out of time, so let me just touch very briefly on 3 possible areas of cooperation. A lot of discussion on the possibility for regional cooperation, as well as plurilateral action on either production platforms or regulatory platforms or clubs, as Bernard used the term, and whether you do it as plurilateral arrangements or you do it within regional agreements, on climate, on regulations regarding security, or on certain production resilient supply chains. Those were some of the discussions. And then, of course, on the multilateral part, we won't see a new WTO round anytime soon. I think everybody seems to agree on that. But the system can be made more relevant. And whether you want to do just a transparency exercise, as was suggested in one of the papers, where it's about a notification, it's about subjecting yourself to informing others what you're doing with your subsidies, or do you want to go to the WTO reforms around subsidies, around even industrial policy, and even around disciplining or putting guardrails on the use of security clauses. A lot of people are very skeptical about WTO reforms, but just to close on a little bit of optimistic note, at least in the most recent WTO informal ministers meeting at the OECD, they didn't mention the security clause, but they did mention issues regarding addressing subsidies, as well as addressing industrial policy, and addressing how to have a dialogue on the use of retaliatory measures and trade distorting measures. So it's not off the table, but of course all of us in this room are very experienced in the WTO. But at least it's there. There's a placeholder. So it's not like it's not being discussed. So let me close there on a cautiously optimistic note. Thank you.
I want to start out also by thanking the Peterson Institute for International Economics and PAFTAD for giving us the opportunity over the last several days to have this very important conversation about industrial policy. And of course, I agree that this conversation could not be more timely. Industrial policy is indeed back. If we look at just one tool of industrial policy, tariffs, we will see that in the last 5 months, the United States has imposed higher tariffs than we have seen over the last 100 years. So industrial policy is definitely back. It's back with a vengeance. Now, of course, we know that countries have always used such policies, so they're not really, quote unquote, new to promote their economies. We can go all the way back to Louis XIV, who used industrial policies to import the Industrial Revolution from England. We don't have to go back that far. We can look at former President Biden's massive IRA, which was an incredible bill to accelerate the green transition, and is one of the largest examples of green industrial policy that we have seen in a very long time. Now, the problem, of course, is that such policies are often poorly designed and poorly implemented. And so some critics, actually many critics, would often claim that the so-called cure, think of President Biden's tariffs, could be worse than whatever could be the disease. So that leads us to think about the following important question, which is, what kind of lessons can we draw on how to do good IP? I'm of the belief that no matter what we may or may not believe, countries will continue to use industrial policies over the next many decades and centuries. So from our last 2 days of talks at the Peterson Institute, as well as from my own research and my own reading, I would like to suggest 6 guidelines on the how to do industrial policy that would be most likely to lead to a successful outcome. So let me begin. I'll start number 1. The policy needs to, quote unquote, correct a clear market failure. For example, the US is likely to remain a major global leader in EVs, but for that we need to make sure that the government is installing charging stations throughout the United States. That is an example of a clear market failure that requires a government solution. We had a number of discussions over the last 2 days about the importance for the need. Devashish Mitra talked about the importance of the link between what is the market failure and what is likely to need correcting. Now, the importance of identifying the failure and discussing the correct solution is become somewhat problematic with the expansion that we just heard about of industrial policy objectives. When the objectives are very broad, such as geopolitical issues, national security, resilience of supply chains, employment growth, it becomes very difficult to target the solution to the identified problem. And in my opinion, it also, because of that, it also makes it much more difficult to succeed with industrial policy. So if anything, it's become more difficult to have a successful industrial policy as the problems that have been identified have broadened in scope. So after identifying the correction that needs to be made, how to go about it. The second suggestion that I have is private sector consultation without corruption. So without a framework that allows the private sector to play an important role in designing and identifying the right industrial policy, we are unlikely to be addressing issues that are either important for transformation or that are likely to be viable. In our conference, we heard examples of these kinds of consultations that were really exciting. In particular, we heard from the former trade minister for Costa Rica, Andres Valenciano, and he described how he consulted extensively with boards which were primarily taken from the private sector. Now, one question that you might ask is, how do you achieve this consultation without corruption, with agency? And we had a number of interesting conversations at this conference about that topic. In particular, 2 IMF economists, Reda Sharif and Fuad Asanab, suggested that one way to ensure that governments are not beholden to the private sector are through what they call their 4A framework: ambition, autonomy, accountability, and adaptability. We've also heard similar sentiments expressed by others, including Mazzucato and Roderick, who have shown that the optimal outcome occurs when there is a combination of what they call the embeddedness of the private sector. In other words, the private sector is very engaged in the design of industrial policy, but at the same time, the government has autonomy, in other words, can resist influence and undue corruption. My third suggestion, which is possibly my most important, is that in any industrial policy, in order to be successful, must be combined with fostering competition. And that's really important. I will give you just two examples, one from my own research and one from the conference, which I think was extremely powerful. If you look at China's experience with industrial policies, which is one of the inspirations for the resurrection of industrial policy all over the world, you can actually disentangle the success of China's different industrial policies in terms of promoting industry growth, entry, transformation. So you can compare the effectiveness, say, of tariffs with subsidies, with tax breaks, with low interest loans, et cetera, et cetera. The worst performer of all these instruments that China has used, the absolute worst performer, and I guess I shall say, which was our president's first choice for a policy instrument, is the use of tariffs. Now, why are tariffs the worst performers? Because they inhibit and restrict competition. So it's the absolute worst instrument. So that's one example. We had another wonderful example in this conference through the very nice paper on Indonesia. One of Indonesia's strategy has been to promote downstreaming, by which they mean they are encouraging the use of upstream minerals like nickel to be able to promote higher value-added goods that use nickel as inputs. Now, the way this policy was introduced, one of the key elements was an export ban on the export of raw nickel. This has had significant negative consequences for Indonesia's industrial strategy, in the sense that it has led to the mispricing of the major input nickel. It is now too cheap. It has led to, as a consequence, all sorts of distortions. Again, if this policy had been maximizing competition, an export ban and local content requirements would not have been the instruments used. The fourth lesson is, number 4, is that policy needs to be able to conclude. There needs to be an exit strategy to the policy. We had some excellent examples in this conference. We were told that in Korea, the reason that the policies work is that, quote unquote, the government had the ability to cut laggards off, quote unquote, from one of our participants. In my own research on China, here's a fascinating fact for me. I've done a lot of work on state-owned enterprises in China, and between 1998 and 2013, 80% of state-owned enterprises stopped operating. That's a massive promotion of an exit strategy. Number 5, what's the 5th component that needs to be there? Very important role for complementary policies. We heard an excellent example of a policy that was implemented this week that was not an example of a complementary policy. Jeff Schott told us about the need, if we are going to promote the auto industry in the United States, then imposing 50% tariffs on steel aluminum in the US, as was done in the last several days, is not the right kind of a complementary policy that will help the US auto industry. Now, of course, there are also positive examples that we can draw on: R&D support, science parks. A number of complementary policies were discussed over the last 2 days. Then the last important component which to me has become really evident in the last 5 months, is the need for consistency. So without a consistent policy, it's very hard for firms to know what the price signals actually are. And therefore, what you've seen in the last 5 months in the United States is that because tariffs have been imposed and then taken away in a whirlwind manner, I would call them not a happy abomination, but a very unhappy abomination. We have seen that this leads to a very inconsistent policy, and it's hard for firms to behave. We also heard from Fernando Martin from the Global Trade Alert that right now we are living in an extremely inconsistent world with a lot of policy turmoil in general, not just because of US activities, and this has made it very hard for firms to engage. So let me conclude on the 6 C's that I believe need to be in place for industrial policy to succeed. You need to correct the externality. You need to consult with the private sector in a way that does not foster corruption. You need competition. You need a conclusion to these policies. And finally, they need to be consistent. Thank you.
Hello, everyone. I'm here as a learner. I note that the title for this session is Industrial Policy Lessons for Asia and the Pacific. The first lesson I take away is that there's wide disagreement about what industrial policy is. I heard on the one hand, from Chad, our moderator, formerly of the US State Department, that America has a view about industrial policy that's laser focused on security, on being able to provide certain kinds of equipment to the American economy. That's not necessarily a lesson that's going to be valuable to me in the Asia Pacific. The considerations are different. Another extreme in terms of industrial policy that I heard about is that it is simply any interference in the market process. Any interference, any intervention in the market process is an instance of industrial policy. The proliferation of industrial policy that we see today is simply a realization that markets don't always work well. And indeed, if you go back 2 years, the narrative from the US administration was exactly that. Markets don't always do the right thing. Not all growth is good growth. Not every trade deal is a good deal. Therefore, advocating industrial policy, which was once considered embarrassing, should now be considered something close to obvious. I don't find this state of affairs very helpful in terms of the lessons I need to take away back to the Asia-Pacific region, where we have always practiced industrial policy, not with an eye to security, but with an eye to promoting growth. Taking into account the idea different from the 2 extremes that I've described of what industrial policy ought to mean. I want to take 3 positive things away from this understanding of what our narrative and the landscape of narrative is on industrial policy. So 3 lessons are the following. First, I want to reject the idea that every market intervention is an industrial policy intervention. The first proposition I'm going to take away is that not all interventions are indeed industrial policy interventions. This might sound obvious and trite, but I want to, before my time is up, come back in a circle to say why it reflects on the diversity of views that I've described to you. The second point I want to take away is that a lot of industrial policy, not just the industrial policy that's laser focused on security, but a lot of industrial policy in the world today is not the way economists think about how policy interferes with markets. A lot of industrial policy is not about externalities and market failure. A lot of industrial policy is not about increasing competition. And a lot of industrial policy is not about promoting growth and stability. What is it about then? Small countries and large countries differ in their approach to industrial policy. If all the industrial policy is obviously valuable things that restore market efficiency, we should all be on the same page. If all the industrial policy is that it disrupts the market process and keeps economies away from efficient allocations, again, we should all be on the same page. But the fact is, different countries differ, partly because of circumstances, partly because our objectives differ. So I want to flesh out what those objectives might be. Then I want to end with the third lesson, that the empirical evidence does indeed show heightened industrial policy activity. Part of that is our going back and rethinking that a lot of things are industrial policy when previously we did not. But there's no question that there is heightened activity in this space. The warning that I take away from this third lesson is that there's also much greater diffuseness now in understanding industrial policy. If America has one view on what it is, it's obviously different from China's view. It's different again from the views that propelled the practice of industrial policy in East Asia over the last 5 decades. But here, I want to leave with a warning. The fact that there are so many different objectives to industrial policy and that we so carelessly use the words industrial policy means that we're in danger of mission creep. We're in danger of setting up industrial policy for failure, and we're reducing the effectiveness of what we want industrial policy to achieve. And if we're not clear about that, we are not going to be able to help the United States in its quest for security in industrial policy, through industrial policy. And we will be unable to help our economies pursue growth and stability. We need to be clear about what those objectives are. Those are the 3 lessons. Let me just quickly flesh some of this out. First, not all interventions are industrial policy interventions. In the bad old days, when East Asia practiced industrial policy, it was to promote growth and stability. It was get our economies out in front. There are many different ways you can do that. Not all of those are industrial policy ways. You can promote aggregate demand. You can strengthen aggregate supply through Keynesian and monetary policies. You can manage interest rates better. You can control inflation. All of those are economic policies. All of those improve people's welfare. All of those advance economies' position in growth. None of those is industrial policy. The second area where economic policy operates is in trade and protectionism. Trade and protectionism is about shifting the relative considerations that you put to foreign interests and to domestic interests. Trade policy need not be industrial policy. Trade policy is about trade. Industrial policy is about shifting the industrial landscape that exists in your economy by favoring some sectors and disadvantaging others. By that definition, you can carry out industrial policy even if your economy does not trade. You're simply shifting the industrial landscape. And part of a challenge that we face today when we think about industrial policy in terms of economic security is we conflate the changes in the industrial landscape with changes in the way in which we treat our trading partners. So we've reached a very unfortunate position where we are no longer clear about what industrial policy is, except that it disrupts markets. It keeps markets from arriving at what they naturally want to do. And economists ought to balk at this. We need to be very clear about why it is that we're disrupting markets. The danger is that economic security is the nuclear bomb. It dominates everything else. Once you put in play an argument about economic security, about keeping your people safe, nothing else matters. And we are in danger now of conflating industrial policy with all other kinds of considerations. So let me conclude. There's a legitimate place for industrial policy. The quote that I gave you earlier about markets, growth, and trade comes from none other than Jake Sullivan. Jake Sullivan was one of the architects of the new industrial policy in the United States. And he had a broad view of how industrial policy considerations can change the economic landscape and improve people's well-being, that operated even without a mention of the word security. Those are fine ideas that we need to take forward. Economic industrial policy can also be about raising government revenue, enhancing supply chain resilience, making national champions, facilitating green energy transition, protecting infant industry. And we are now losing sight of all of these different considerations for industrial policy if we shoehorn everything into one of two extremes. The industrial policy is anything that disrupts markets, or industrial policy is only about security. So I end this intervention. What do I want to take away from industrial policy lessons for Asia and Pacific? I say I go back to a region where growth and stability matter, income inequality is a consideration, people's well-being matter. I believe still in open markets and free trade, and I need to triangulate that with extreme views of industrial policy. Industrial policy, if it moves away from market discipline, needs to develop institutions that replace the institutions of market discipline. A 4A's approach: accountability, autonomy, keeping in sight institutions that keep in check corruption, rent-seeking. All of these are good ideas. None of these need have anything to do with military security or national security. So let's be clear, when we carry out our empirical analysis or industrial analysis, let's write down what our industrial policy is seeking to achieve, but let's not try to take a blunderbuss approach. If our concern is economic security, is the security of our people, put that up front. That is no less legitimate a consideration, but it is different from other considerations for which industrial policy has been important. Thank you very much.
We've heard a lot about new industry policy in the past couple of days. It reminds me of modern monetary policy. Not all of it's new, and not all of it's right. And the bits that are new are mostly not right. there are new issues that have to be addressed. A heightened concern for security. Chad, in his introductory remarks, introduced those. Helped along by the COVID crisis and the recent return to war in Europe. Also helped along by the success of the Chinese economy and its increase in relative strength in relation to the United States. And for those of us who've been in this conference over the last several decades, that is not all that new. We saw similar visceral reactions when, through the 1980s, it appeared for a while that Japan would be number one. But of course, that was simpler in security terms, but it gave rise to many similar reactions in the United States. The principle that Jake Sullivan used to describe proper treatment of the security issue, a small yard, high fence, is the right principle. What's missing is a disciplined application of that principle. And as several commentators in this panel have said, there's serious danger of security becoming a justification for almost any intervention that someone thinks is a good idea. We all await Chad's book later in the year, applying some of his experience in the State Department to the principle of small yard, high fence. The second issue that's become more prominent that we have to deal with is the imperative of decarbonisation. Atmospheric physics, taken to its greatest height in the great universities of this country over the past half century, atmospheric physics does not change with a change of president in the United States or the United States withdrawing from international cooperation on climate. The world faces dreadful challenges from the change in the climate, from warming, which, if we do not change course, will seriously destabilize many aspects of our economic life and our security. Most of the world is recognizing that we've got to work strongly on that, and that has given rise to calls for many interventions, some of which are ill-disciplined in economic terms. We need the old industry policy, the old principles of economics to get this right. When there's an externality, you've got to correct it with a tax for a negative externality, the carbon emissions. You've got to provide fiscal support for positive externalities. In this case, the imperative of rapid innovation to build new ways of doing things and a new economy. There's a sound old economics case for support for coordination of new economic activities, coordination of infrastructure because of the public goods nature of infrastructure investment. Also coordination in areas of information where there's an important public good, in this case, an international public good from expansion of knowledge. Correct these market failures well, as old economics tells us we should, then we will deal effectively with the climate problem. On climate, the Europeans are closest to getting it right, and their recently legislated carbon border adjustment mechanism is fully justified on economic grounds as part of getting that right. The third big change we've had to deal with is the breakdown of US commitment to a rules-based international trading system. The withdrawal of US support for the WTO, which began in the first Trump presidency and has gone much further with the extraordinary trade policy changes of the last couple of months, takes that to new heights. That there is a danger that these changes in the United States and reactions in other countries will lead comprehensively to weakening and perhaps withdrawal of the one discipline that can help us to get other aspects of industry policy right. In the countries which study and experience has shown we're able to use things called industry policy effectively for development. But one thing they have in common is that they were very much subject to international market disciplines, deep engagement in the international economy. Murray mentioned the important role of export orientation. The withdrawal from international trade removes that one discipline and makes it much more likely that we will make industry policy interventions damaging to economic development. The biggest breakdown of the international trading system is in trade relations between the world's two biggest economies, the world's most important economic relationship between China and the United States. If we all react unintelligently to that, there's a serious danger that we will lose the role that international trade has played in promoting global development. The extraordinary growth in incomes through much of the world that we've seen over the past 6 or 7 decades, and most intensively over the past 4 or 5 decades. So how do we keep global development going in this world of United States withdrawal from a rules-based international trading system and Chinese retaliation against that? Can we keep it going? And if we can, how do we keep it going? Well, the basic arithmetic says that we can, even if the US withdrew entirely from international trade. Trade in the rest of the world without the United States is many, many times bigger than trade with the United States was in the early 1980s when China embarked upon its internationally oriented growth, and several of the larger, more populous countries of Southeast Asia embarked upon internationally oriented economic growth. So the world is large enough to accommodate continued internationally oriented growth throughout the world without the United States. The arithmetic of what happened in the 1980s tells us that. Obviously, it would be very much better for everyone, especially the United States, if the United States continued to be part of that global trading system that the United States led in the creation in the decades after the Second World War. How do we keep things going? Well, the essential thing is that a critical mass of countries, especially if they're countries of substantial size, remain open to each other and do not follow the United States into inward-looking approaches to development. Doug Irwin's important history of US trade policy a number of years ago showed that a lot of the biggest costs of the descent into protectionism, the Smoot-Hawley tariff of the early 1930s in the United States, a lot of the biggest damage came from the emulation of that in other countries. It's very important that we don't get that emulation. It's best if other countries don't retaliate against the United States, remain open to trade with the United States itself. Not all countries will follow that, but we can get by with keeping global development going by avoiding new protection, new discrimination amongst countries other than China and the United States, keeping open a substantial part of the world economy for development-oriented expansion of trade. There will still be pressures for and a case for some interventions in trade amongst other countries. These can be handled by the disciplines that have been developed over the years in the World Trade Organization. That means we'll need to keep the WTO alive without the country that played the biggest role in establishing the WTO at the beginning. That's not easy. It may not happen. It's a necessary condition for us keeping global development going without the United States. Which countries are ready to be part of that critical mass? Well, in this conference, we've seen lots of reasons to expect that the ASEAN countries can be at the center of that. They're not small countries in international trade, not small countries in the world economy. Australia and New Zealand, relatively small, but closely linked to ASEAN on trade policy things, and wanting to participate in that critical mass of countries that avoid new protection, new trade discrimination. Canada, under its new Prime Minister, has articulated a vision of being part of a rest of the world that remains open to international trade and is a logical participant. Japan and Korea have strong interests in doing this and can play an important role. The critical mass of countries committed to open trade would of course be more substantial if the United Kingdom and the European Union were part of it. Both could be. The US-UK agreement points out that there's a risk that they won't be. There seems to be elements of discrimination against the rest of the world in the United Kingdom's acceptance of conditions on trade in methanol and beef, although not all of the facts are in the public arena yet, so we will have to wait and see. That's not all promising. The European Union has good reason to remain open to the rest of the world. It would be better if they were like the ASEAN countries and Australia, avoiding retaliatory action against the United States. But the critical thing is that they avoid new protection, new trade barriers, new discrimination in trade with the rest of the world. There's going to be a particular challenge to us all remaining open to trade and avoiding new protectionism from the diversion of Chinese trade, Chinese exports that was once going to the United States. And we've had considerable discussion of that in recent days. Pressures on Southeast Asian countries from diverted Chinese exports, lower priced exports, introducing pressures for protectionism, which could damage the opportunity to keep the rest of the world open. China has, in its own policy processes, the opportunity to provide the best solution to that. The best solution to that is a macroeconomic adjustment in China, expansion of domestic demand, reduction of net exports, raising the standards of living of the Chinese people, incidentally raising the real exchange rate, reducing net exports. That is very much in the interests of China. Policy decisions in China since Liberation Day have been in that direction. It's very important to the success of global development in this under these new challenges that China continues with that adjustment far enough to take away some of that pressure on the rest of the world. I see successful Chinese adjustment to increase domestic demand as being probably a necessary condition for both the success of the Chinese economy and the world economy in this difficult period after the new retreat into United States protection. And if the rest of the world gets it right, one of the great benefits of that, of course, will be continuations of that beneficent process of global economic development that has been taking very large numbers of people out of poverty now for quite a few decades. That will continue, and another virtue of getting it right will be that it will become easier and more attractive for the United States to take its proper place again close to the center of an open and developing world economy. Thank you.
Thank you. If we can invite all the panelists up to the table, we'll get situated. And so for our audience, what we're going to do is we're going to open it up for Q&A. I have questions, but I'd much rather hear questions from you. We have a roving mic or we have a standing mic. And what I would ask you is please ask questions as opposed to making statements. And please introduce yourself before you ask your question, name and affiliation. So we'll start at the mic.
Hey, I'm Barbara Stallings from Brown University and Tsinghua University. I last saw many people in this room at a PAFTAD conference in Korea a year and a half ago. I want to go back to where Chad started. Chad said that the old industrial policy concerned with growth is just not very relevant anymore. He said that we should read Ann Harrison's essay, but it still isn't very relevant. Danny began to challenge that divorce between industrial policy for growth and for other broader objectives. But I wonder if I can convince Ann to push a little further on this issue of whether the old industrial policy for growth is really all that different. And can we learn something from the old industrial policy? Maybe that's where you think your 6 guidelines came from, but maybe you could elaborate on that a bit for me.
And I will let you do that. But before, I should have been clear in my opening remarks, which was I didn't think that this framework was particularly right for understanding what the United States is focused on right now, which does not seem to be about, always. Sometimes maybe there could be an industry where there could be learning by doing and development and economic growth purposes. But for the US's particular objectives, from my experience, it seemed to be about something else as a general framing. But Ann.
To be completely honest, I was going to avoid confronting Chad because I have a very high opinion of him. But on this issue, I happen to think he's wrong. So that is slightly problematic. I do believe.
No, it's all good.
I do believe that many of the issues that have been developed over the decades or years or whatever are still apply today, and that you can couch the the president's goals in the same framework as before, whether it's bringing manufacturing back or bringing high-tech manufacturing back, or you know, creating a level playing field, whatever those are. I think that those can all be understood within the context of certainly the paper I wrote 10 years ago with Andres Rodriguez-Clare still applies. So I don't see a big difference. One way in which I do believe that there has been a fundamental shift is not so much in the changes in the framework, but I think there's been a complete disregard for the distributional consequences of trade and the rising inequality, and that there was no solution proposed. And I think that's really the fundamental problem, which I believe is actually a different problem than what industrial policy is trying to address. I think that all sorts of issues need to be addressed there, whether it's more equitable education, health opportunities, changes in marginal tax rates, et cetera, closing the loopholes. I don't think that that's within the realm of industrial policy.
Devashish, is that? And introduce yourself, please.
Yeah, I'm Devashish Mitra. I'm a professor of economics at Syracuse University. If a government wants to promote some kind of sophisticated manufacturing, such as semiconductor production, you need to have a workforce with the right kind of skills. So now, of course, then the government should be promoting and strengthening institutions of higher learning to create those kinds of skills, not attacking them and treating them like their enemies. But nobody really talked about education policy or higher education policy as industrial policy in this conference. So, because employers constantly complain that they don't find people with the right kind of skills. So, is education policy also industrial policy? And the second question is about tariffs. Danny mentioned that tariffs are not industrial policy, and said tariffs are bad industrial policy. So if I just go back to old trade theory, a tariff is a combination of a production subsidy and a consumption tax. You'll probably all agree that production subsidy is industrial policy. So a part of tariff would be industrial policy. I mean, the production subsidy always promotes competition, domestic competition, because it leads to more entry. It's the consumption tax that actually kills competition from abroad. So Anne is actually right that tariffs overall would kill competition, because the negative impact on competition from the consumption tax part of the tariff always outweighs the production subsidy part that promotes domestic competition. So I would like to know, how would you still say that tariffs are not industrial policy? It's bad industrial policy. I agree with Anne on that, but it is industrial policy. So two questions, one on education policy, the other on tariffs.
Okay, if I may, I like it when people quote me, but I don't think that's exactly what I said. What I said was that there's something called trade policy, which has to do with the relative considerations you put on domestic interests versus foreign interests. And then there's something called industrial policy, as I understand it today, which is about shifting the distributional shares of different sectors in one's economy. sort of a first pass thinking of what Trump is trying to do with tariffs is that he has a view that this will adjust the bilateral trade deficit that your economy has with mine. That's about managing trade. On the other hand, today's elevation of aluminum and steel tariffs is about distorting the industrial landscape within the United States, favoring the aluminum and steel producing industry and disfavoring those parts of the American industry that use aluminum and steel. And so that is a distortion. The reason I want to emphasize it is not to get too technical about it, is that it helps shed light on the goals that we want our policies to achieve. If we're not clear about those goals, then talking about the instruments does not allow us to judge whether the policy is a good one or a bad one. So although I did push back against Chad for his emphasis on security, what I said was that that's a consideration for you, it's not necessarily for me. My economy has different sets of issues. And so it's simply trying to be clear about what goals we're trying to achieve with industrial policy, using what shifts in the distributional share of the landscape versus what instruments we actually have to use. And a conflation of trade, of growth, and of industrial policies is just bad policy generally. We are no longer clear about what we're trying to achieve.
Please.
Let me try to answer the education question. I think it's wider than education. I think it's human capital. I think Marcus made this point, because I think if you're in the kind of the usual way we think about industrial policy, if we're trying to develop a certain sector, then you have policies that either restrict or give subsidies. Hopefully, using the good guidelines that you do it in making sure there's competition and a time bound. But at the same time, you need to develop your human capital. And I think it's not just education policy, but the role of foreign direct investment. I think Khatib Basri brought up the example of Citibank, how a lot of the Indonesian bankers learned through being part of Citibank and growing through the ranks in Citibank. You have IBM as another example. I think in Taiwan, the semiconductor industry all developed because of them starting to work in multinational companies. China very strategically invited the types of foreign investors they wanted because they wanted to learn. So you develop your human capital through direct experience with multinationals. That's why openness to foreign investment is important. And second, you can have very targeted education policy. How many engineers you train, for instance, will get you to the sectors that you want, for instance. So I think it's a combination. It just means that I think industrial policy cannot just be one instrument, just because it needs many things are needed for you to be successful, to develop and grow a certain sector, or even to have growth and stability. So you do need whether they're called complementary policies or whether they're part of your strategy. I think that's the key word, probably strategy, of wanting to develop a certain sector or develop a certain part of your economy.
Addition to Mary's point, the United States has been the world's leader at the cutting edge of high technology industries for a couple of generations. There's no doubt that one of the important foundations of that has been the extremely high quality of research and education in the best American universities.
Please.
My name is Prita, PhD student at ANU and visiting fellow at Yale. Thank you so much for the discussion, and I think my question is a bit different from the topic, but I think following the similar questions from Devasis. So I'm curious how gender considerations factor into today's industrial policy. I think we haven't really discussed that much. I mean, you mentioned about education, higher education, and skill formation, but what about from a gender perspective? Yeah, particularly I'm working on development and labor. So in many developing contexts, we know that industrial policy has the potential to reshape who gets access to formal or like decent work, but often gender outcomes are treated as side effects or like spillover rather than the design goals. And how can this industrial policy be made more intentional in promoting gender equitable employment, especially in sector that is traditionally dominated by men? And are there examples where gender inclusion was baked into industrial strategy from the start? Thank you.
Okay, before anybody answers, I'm going to ask one last question, and then we're going to go down the line because we only have 5 minutes left to give everybody a chance to say any last things that they want to get out there. So the last question that I wanted to kind of throw out there was getting to this point of communication, and I think a lot of this is we're talking past each other. So Anne, I'm going to disagree with you disagreeing with me because I agree with you, and I think I'm not saying you agree with me, but I think it's I don't think I made myself clear the point that I was making, and anyway. But this is where we are, right? What are we even talking about? So we're now at a stage where we have to define specifically what we are talking about in advance to make sure we're not talking past each other. And I guess my question, this kind of came up with a paper that Bernard gave as well. We're thinking about international cooperation. What do we do? Is it possible that you have potentially weird constellations of countries that had never before had the chance to get along in groupings might all of a sudden have the incentive to cooperate, even though they might have different objectives for why they're doing industrial policy. So I may be doing it for security reasons. Danny, you may be doing it for growth reasons. Anne, you may be doing it for equity reasons or something else. Is there an opportunity, because we're targeting the same sector or something, for us to actually be doing this in a cooperative way, or is it always going to lead to conflict? So that's sort of one open-ended question. And the second is, I think it's probably our job as economists to be looking ahead, recognizing that this whole thing is going to go badly, and being ready to help clean it up, right? And so in a sense, I'm looking at Will Martin, because there's probably other amazing agricultural economists in the room, but I know he's one. And this made me think of, this is sort of maybe where we were in the 1980s, right? When we had all these different countries that were doing crazy things on agriculture, but they weren't using different policy instruments. And we were probably talking past each other in terms of what it is that their objectives were and what they were doing. So we had to develop a common language first to do all that, right? And so the OECD got tasked with developing PSEs and CSEs to be able to measure things, to just be able to have a common language for what the different countries that were using different instruments were doing, so that they could then begin to get in a room to negotiate over how to kind of corral that together in more cooperative. But I'm not an expert on this, but my sense is there was a period there where it was a mess, and that may be where we're headed. But our job could be, when you're ready to start cooperating, here are the things that you're going to need to have in mind that we can measure. Anyway, those are some thoughts. We are going to have to conclude in a couple of minutes, so I want to give each of you maybe 1 or 2 minutes just to wrap up with, react to that, react to the gender question, or anything else that you want to say. Mari, we'll start with you.
I think on gender, I think you can definitely build in the issue of, if your objective is to make sure that you are going to have labor force participation of women in the positions of decision making, or in the professional sense, in the sectors that you want to develop, you should build it into the policy. I think you can do that, starting from the education and the access part of it, that equal opportunity for STEM education, or even affirmative action for STEM education, as an example. On Chad's 2 points, I think I do believe there is a way forward for us to think through in terms of plurilateral platforms, and I do think making it more, more manageable by looking at either sector or regulation and sector. If it's a little bit like the small garden, high wall thing, if you look at the sectors that are of security concern, whether it's critical minerals, whether it's semiconductors, what are the secured resilient supply chains, for instance, that you want to be able to secure? And what are the industrial policies, whether it's, you call it industrial policies, what are the responses in the different areas, whether you're an exporter or an importer? And on regulation, you know, like for something like climate, I totally agree that can be plurilateral. And go badly and clean it up, I totally agree, but I think what we need to do is to start with the data, you know, understanding what's happening out there and which ones are really damaging, whether it's the damaging use of subsidies or the damaging use of security exclusions, and then understand. I don't think you can have a common language before you have the data there. And I would start with the ones that are already that we already know we need to do, which is like subsidies and the use and the impact. I think what we haven't got good data on is the distorting impact of many of these industrial policies, because that's where you want to be coming up with the policies and the common language.
I agree with Mari that we don't have the data on outcomes. I mean, there are a few studies, some really excellent ones. Part of the challenge is we are not yet agreed on whether industrial policy is about distortion or is it about creating new champions and overcoming externalities. We need to be clear about that. I especially like, however, Chad, the challenge that you posed is can different nations who don't agree with each other, who might even have views that are in opposition to each other, nonetheless end up acting as if they are cooperating? And yes, I think that's possible. It's something that I've been trying to develop called inadvertent cooperation, where each of us, we're trying to do something for entirely the wrong reason, but together we end up doing the right thing. Inadvertent cooperation, and there are wonderful examples that we can use from arms races, from subsidies, and I hope that we can apply them to think about industrial policies that will move us all in a positive direction. Thank you.
So now I'm going to agree with your agreement. So I think it's true that we were thinking about different situations. Take a standard problem where there's too much carbon in the atmosphere and we need to put a price on carbon. There hasn't been a change. The first best solution is always a tax on carbon, and I think we would agree on that. I think what you're looking at is this new global, essentially, conflict, partly arising out of inequality concerns, where we've been in a world of cooperation for the last 100 years, and now we're in a world of conflict, and it's tough to know to how to set the guardrails and how to avoid fallout to the other players, and you're absolutely right. So I think it's great that we can agree to agree. On the gender issue, I don't think there's been enough done on these issues. Preeta, I think it's definitely the case that more work needs to be done. It could be an interesting area for analysis. I actually personally just wrote the first gender paper in my entire life because I was shocked as dean to see that as women and men graduated with an MBA from Haas, they started out with the same wage, and then 15, 20 years later, the wages diverged and men are making or were making 50% more than women, and this really bothered me. So I have looked into the gender disparities which exist in the United States quite clearly, particularly for the top end of the distribution.
I'd like us to continue to apply sound and tested economics to the new issues. And if we do that in a disciplined way, we'll deal with the new issues at a minimum of cost to economic development.
Well, with that, let me say thank you to the audience and all of our panelists. It has been a wonderful 3 days for the PAFTAD conference. And please come back to the Peterson Institute again soon.